Hello, hello, hello. It's Stefan Angelini from Angel Advisory. It is Friday, the 10th of Feb. We're going to have a bit of an economic update and just let you know what we're going through today. We're talking inflation and what's causing inflation and fears of recession. We're going to be going through a new government initiative that's basically making people report on the gender pay and gender equality gap. We're going to go through some things around the world, but also we're going to run through some key economic indicators that have been released by AMP just recently. And then finally, we're going to finish it off with a bit of fun. I'm going to show you why superannuation is so good from a tax perspective. So bear with me as I pump this out. Just to let you know that anything you hear is just general information. Please don't consider it as personal advice. And if you want personal advice, go and see your licensed financial advisor. Now let's kick it off that basically the Australian share market was followed Wall Street and was down a little bit overnight. So let's see what happens around the rest of the world. Just to give you some key economic indicators and what's going on. So there was a news article in news.com.au. You wouldn't believe it, but a bit of a fear-mongering headline where they're saying that Australian recession fears rise to 70% amid ongoing interest rate hikes. Now, they did go through to mention that there was only really one economist that said that it could be there's a 50 to 70% likelihood that Australia is going to enter a recession. But if you've been listening to my recent market updates, well, you know that a lot of economists around Australia are indicating that we will steer away from a recession. To get you into inflation, AGL is seeing a significant power rise or cost of power bills flowing in the next few months, in the next 12 months more specifically. They've had a big hit to their earnings, and they see that because of some of the government initiatives that the cost of power and energy is going to continue to rise for Australians. So please watch out. For those of you who are like me and care about ESG, environment, social, and governance, the government has introduced a gender pay gap bill. So now any companies that report that have more than 100 staff as of 2024 will have to basically report on their gender pay gap. There's a pretty big compelling reason. Now, the Minister for Women, Senator Katie Gallagher, has said that the gender pay gap is holding our economy back with $51.8 billion a year of lost something when it comes to women's pay. Now, if that means that it is lost GDP when it comes to women's pay, hopefully that this little initiative and this bill that has passed now in 2023 called the Workplace Gender Equality Amendment to basically close the gender pay gap 2023, hopefully this can cause some great, economic advances to us. Some really good, compelling reasons, as I just said. Now, around the markets, what has been one of the biggest asset classes emerging is the world of private credit and private debt, becoming hugely popular, especially because the reserve banks are now increasing interest rates around the world. These trade off margins against these cash rates. So as the differential between dividends from, say, Australian shares compared to private debt income, as that starts to reduce, there's a lot more, attention towards these private debt providers. However, there is still a lot of people talking about the case for long duration government bonds. So this is more for us financial advisors or us money managers to figure out how we provide you the best asset allocation. Long duration government bonds is what you'll see in a lot of your balanced index funds for your defensive portions. But now with these government bonds paying around about 4%, with hopefully interest rates near their peak, once interest rates starts to fall, then the inverse relation between the price of a bond or the value of a bond will start to be more beneficial, because as interest rates start to drop, then the return on these government bonds will start to increase as you've got the longer duration. So they're saying that, it may be time to start looking at the longer duration government bonds, even though we've got a few more rate increases on the horizon. Now, let's watch out for Aussie equities. We are entering earnings season. A lot of banks, for instance, are coming up to start to report on their earnings. From expectations, especially from banks, we're expecting that they will report really good profits and probably beat expectations because of their net interest margins. That's the margins they make on things like loans out. Whereas next year they might struggle a little bit. So it's going to be really interesting to watch this as it comes out over the next few weeks. And that's the December reporting that's coming out. Now, you would have seen, if you are watching the markets, that the US markets are starting to report, and they or have been reporting. Now, a company like Disney has had a massive uptick in their earnings outlook, and a lot of companies are beating their earnings expectations as they start to report, which is making the US market continue to drive faster and faster. From an impact investing perspective, President Biden has got a new inflation law that is driving more sustainable investment and opportunities. Basically, they're going to see a lot more investment into onshore wind market, which has been pretty flat. But hopefully some of these new laws are going to boost that sustainable energy production. And we're hoping that so that the world can live a lot longer. Now, with financial markets and expectations, what's coming up is there has been a new uplift to China's growth forecast. Basically, China's GDP has been tracking on average at around 7-8% for the last 10 years. Now, there was an expectation that it would be between 2 to 3 or 2 to 4%. It's now increased to 5% for 2023. So hoping that the China opening up is going to be a great news for their economy and it can start ticking back to where it was. Finally, AMP have released their macro investment outlook for February. Now, AMP have had a lot of issues in the news, but still they are a research powerhouse and they've got some really good indicators. Some of the things that they have mentioned is that there has been the rate increases have not been seen anytime in the past, unless you're in Australia. Around about the early 90s, you saw some really, really quick rate hikes. But fortunately now around the world, rate hikes are starting to slow down. No longer going by 0.5 and 0.75% per increase. It's now dropped off to about 0.25. A really interesting graph by them was the difference between getting Australian dividends and the return you get from an income perspective on Australian dividends versus the return you get on your bank rates, basically. So there's still around about a 3% difference. So you're getting 3% more in dividends from Australian equities as opposed to income from cash accounts, which is going to keep people in Australian equities. In terms of the house prices, they still predict that house prices are going to fall by 15 to 20% and bottom in the second half of 2023. So what's that? That is around about September, October. So we'll see what happens there. They're saying that price affordability, high household debt, and all these fixed rates coming off are going to put more pressure on the property prices, especially as there's a lot of pressure on the cost of living, mainly around inflation. Some other really good indicators is that the Australian dollar, they see to get a lot higher because of commodity prices. And now if you've been watching, the Australian dollar has come off, which makes it very expensive if you want to travel to America to get US dollars. But if the Australian dollar does tick up, it's going to be better for our importers and better for people that want to travel overseas as our Australian dollar gets stronger. But with the falling Australian dollar, it's been better for our exporters, which means that big companies that export a lot of resources, which is what we do in Australia, can perform a lot better because they can sell things cheaper to overseas people. Now they have released their expectations and long-term expectations for different asset classes. And basically what they predicted is that they think that the emerging market economy, excluding Japan, is going to be the leader when it comes to long-term returns. So there's a lot of focus around emerging markets. Finally, let me just take you through to the superannuation environment and why we love it. So as you might know, that you get tax and earnings rate of 15% when you've got money in a superannuation and accumulation phase. Now, when you have Australian dividends, Australian shares or investment in Australian shares, they do sometimes pay fully franked dividends so that they pay their tax at 30% before you get that money back. So if a company, I'll give you an example, if a company declares a dividend of $10,000, they'll pay $3,000 in tax. Let's say they earn a profit of $10,000, they'll pay $3,000 in tax, and therefore they'll have $7,000 left over. They want to pay this all out as a franked dividend, and let's say you're the only shareholder, then they will pay you $7,000 in cash, but then you'll get a franking credit of $3,000. Now, you add that back, so you earn $10,000 on your assessable income. In superannuation, you get taxed 15% on that, which is $1,500, but then you get the $3,000 back. So you're up $1,500, which is why we love the superannuation environment, because taxes need to be considered whenever you make any investment decision. So that's me for the wrap up for today. It's the 10th of February. Have a fantastic weekend, and we will see you next week. See you later.